Hello, and welcome back to another episode of the Collective Clicks podcast. This is your host, Brandon Bateman, and today I have Donato on the podcast. He has been building a platform called Bright Investor for the past couple of years, all focused on data around comping, dispositioning properties, and targeting markets. So I'm interested to pick his brain to see what he's been doing and what advice he has for people that are looking for markets to target PPC in. I'll see you there. Donato, welcome to the podcast. How are you doing today?
I'm doing great. Thanks for having me here today. I appreciate it.
Yeah, I'm excited to have you here today. We've been talking for just a few minutes before the episode, and I think you've got some pretty interesting things to share. And I'm really curious to learn more about you and your business and everything. But for anybody listening that doesn't know who you are, what you do, um, why don't you share that with us?
Yeah, so I started in real estate in college as a wholesaler and quickly grew to a four-unit house hack, which then turned into 375 units in a 35 million portfolio by 25. Most recently, a 200-unit deal in San Antonio. Now I grew that while I was working full time as a geospatial analyst for the U.S. Department of Defense in the intelligence community. So you know that means long days and long nights, getting off work and going right into work. But it was through that process that I was able to actually retire from my day job, and I got kind of tapped on the shoulder to come be the head of acquisitions for a multifamily investment group. And since then, I've analyzed over 3,500 deals in the last 6 months, and basically took all of that and wrapped up my experience in this framework for getting deals faster in better areas into my software company, Bright Investor, which I founded a few years back. And now I full time as real estate investor, software CEO for real estate investors across the nation.
Okay, cool. Yeah, sounds like you've been busy doing
A little bit.
a lot of stuff. My story is not so different. I started my company in college as well,
There it is.
which yeah,
Birds of a feather.
that's right. It's a fun experience. I can't say I experienced very much of the college thing. Once I started the company, I just like
Yep,
sort of show up to every class that you had to be in. And basically do nothing that you don't have to do
exactly.
and work while you do all the other things was kind of my experience at college.
I remember vividly going on a retreat with some fraternity brothers, and they were going out, they're having a good time. And I was on my computer, just on the phone with real estate agents and investors in St. Louis before I moved, getting feedback and talking to them about this product. And I remember vividly one of them walked by me and they're like, Donato, why are you this way? What's causing you to do this? Like, why? And the only thing I said back to him was, why not?
That's fun.
Why not do this?
Yeah.
Why not try? And it was just like very much as you started going that path, this divide, this grows between there's nothing wrong with the direction you're going, but it's not for me. And the college experience becomes this is a tool for me to build my future, not this $50,000 party that I'm supposed to then pay for the next 20 years.
Yeah.
So it's just different choices, but I've enjoyed where they've taken me so far.
Yeah. Yeah. I think it created for me, I'm sort of, it may be sort of a unique case study because I'm the kind of person with the risk tolerance where if I didn't start a business at that point in my life, I probably wouldn't have at a later point in life.
Hmm.
Because if you think like when you're in college, your number one asset is your low opportunity cost.
Yeah,
Like, what are you
absolutely.
choosing between? You're probably choosing between like making $15 an hour somewhere, or maybe even an
Yep,
unpaid internship and starting a business, right?
absolutely.
It's really not hard. I remember like after 1 month of doing this, I already was like
Yeah.
making more money than I would have with like the kind of jobs that were available to me at that time. It's just
Hmm.
so easy versus like I can't imagine leaving like a 6-figure job to go out and do something that'd be
Absolutely.
so much
I
fun.
get all the people all the time, and I think youth is a huge benefit to starting something because I don't have a spouse necessarily to
Yeah.
take care of. I don't have kids to take care of. I'm not funding a college 529 account. I know I'm not reliant on this healthcare to replace my knees in a couple of years. There's so many things that I'm not having to accommodate for, and all I've had to do since then just keep living like I'm in college and I'm fine. There's no issues. Like, I have no other responsibilities beyond just growing this business, and I'm not really giving up anything else. So you're 100% right. Now I just at this point it's like I make so much more, or I'm having so much more fun working with people that my old coworkers. I remember a very specific time that I asked this guy who'd been working there for 17 years, no kids, so government job. He might be close to retirement, low six figures. And so I asked him, "Hey man, are you close to clocking out of here and retiring?" And he laughed in my face, like a insulting laugh in my face. I'm like, okay, clearly I'm missing something. And he said, "Donato, I've mentally prepared to do another 17 years." And that was the thing that shattered my mindset around him, because he was spending 17 years like spare change,
Yeah.
just writing off 17 years. Like, you understand that through entrepreneurship and business, real estate, you can be out of here in 3 to 5. He's like, "Well, we want different things," and I had to say back to him, "Actually, we don't.
Yeah.
We want the same things. You're just not willing to walk this way to get it, and that's going to cost you for 17 years."
Yeah. That's a super fair point. Lots of advantages to getting started young. Although I can tell you the number one disadvantage for me was that I'm an idiot. And I firmly believe that me in 10 years will be. It would have been really
Yeah.
nice to start the business at that point. But
Yes, I have made so many mistakes.
here we are.
I know in your mind you're thinking, "Oh my gosh, if I knew then what I knew now, I could have done this twice as fast, twice as cheap, with a better hairline and a better waistline than I have now." Absolutely.
Yeah.
You've got at times that you just run face first into a brick wall because you're young and naive enough to think that you'll have it all figured out, that you don't recognize the huge risk, and so you just start running anyways. And it's that exact inertia that ends up taking you the direction you need to go, because you're not scaring yourself off the very beginning.
Yeah. Yeah. That's a super fair point. So let's talk about what you're good at. Like as a person, we'll talk about like your companies and sort of what you've been doing too. Because I'm curious to hear about that. But what's your superpower? What's your skill?
My superpower is real estate acquisitions and market research. That is what I do every single day. That's my bread and butter. And I spend a lot of time talking about it and analyzing what's working and what's not in markets and properties across the country.
Okay, very cool. So if we're going down that route, I'm going to start kind of steering you in a way that I think a lot of the people listening might appreciate. I could tell you one of the most common problems that we're trying to solve on a day-to-day basis, and I don't doubt we could be much better at solving, is understanding where we should be marketing. And there's so many different aspects of that. Like, where we should be marketing means more than just which markets.
Yes.
It could mean where within those markets. It could also mean which markets. It can mean which states. It can mean where do you draw those lines exactly, right? Because there's a lot of
Yes.
places where like one area of the county you're killing it, the other area of the same
No.
county you're not killing it, right?
Exactly.
So there's like to give a brief overview, like the problem we run into a lot with PPC marketing. The wider you can target geographically, the lower your lead cost gets. So we have this rule for location targeting. It's kind of like if you go to court, they're going to ask you to tell the truth, the whole truth, nothing but the truth. We say same thing for location. You got to target the right locations, and that's where a lot of people stop. But then also you have to target all of the right locations, and also you have to target none of the wrong locations, right? Or nothing but the
Yep.
right locations. So, because here's what happens if you have like, let's just say there's an area that's like not desirable to anybody and everybody knows it. I'll give you a good example. This would be like the Detroit city center. All right, so I
Sure.
want to target Metro Detroit. The city center is a little bit run down. It's pretty bad, right? There's actually no shortage of motivated sellers because they're true motivated sellers because they really can't sell their houses, right? And when the house fully renovated can sell for $8,000, there's not that much money. There's not that much meat on the bone for a wholesaler. You pick it up for $0,
Exactly.
you're still not doing so good, right?
Yeah.
It's just not
Exactly.
a place to be doing deals, right? So what do you think happens in the Detroit city center? Well, all the companies that are targeting Detroit, they probably say, I don't want to target the Detroit city center. So then what happens when you as the investor come in and you do target it? Well, what you're going to find is when you're bidding in the auction, you are the highest bidder in the Detroit city center, and you're not communicating to Google that there's any difference in the value of those leads to you. So what you find is you start to get a ton of leads from there, and those leads are actually low quality, and that starts to hurt you, right? So just including like one wrong area, the risk you run with PPC is you spend a lot of your budget in that area because it's less desirable to other people as well.
Exactly.
And on the contrary, if I'm just targeting areas A, B, C, when there's also an area D out there that's equally good as ABC to me. I might get a 15% lower cost per lead if I was targeting area D as well, right? So it's not just about me finding the right areas to be in. It's about me finding all of the right areas to be in,
Right.
because that's how I get a lower cost. Whether I have $100,000 a month budget or I have a $10,000 a month budget, that's true, right? So those are the problems we're trying to deal with. Is how do we determine what these areas are? So if I were a real estate wholesaler reaching out to you saying I could target anywhere in the United States, I just have to figure out like where exactly are the right places for me to target, and I want to use data to do that. What's the path that you would guide me down?
Right off the bat, I'm looking at median home price, days on market, and new listings coming on market when I'm looking at areas that I want to target via wholesaling or recommending to wholesalers.
Okay, so
So,
let me recap that.
yeah,
So median home price is
yeah,
on market. What was the last
yeah.
the last couple ones?
The new listings coming on market.
New listings coming on market. Okay, so the median home price, that's going to be a very like I mean, it changes, but somewhat stable metric. Like it's not going to be like a world different in a year, I imagine. But the days on market, that's probably like a constantly shifting metric as well as new homes on market.
Yeah, and actually, with by tracking them monthly, you would be surprised how much volatility there is in median home prices. And people, I use lots of examples like this. I'll use examples of Evansville, Indiana, and then I'll do something like Columbus, Ohio. And when you look at median home prices there pre 2018, what I call pre COVID era, right? We're looking to see what were home prices doing, what was natural market appreciation and demand looking like before workers were relocating and there's a huge shakeup in where people were having to transact in properties. And you can track as COVID goes into 2020, 2021, huge spikes in the actual median home price as we continue to see this huge jump up in median prices until about 2023 as interest rates start to really take an impact onto the actual housing market.
Yeah.
Very specific markets across the US and then specific zip codes within those markets not only did not drop median home price month over month for the past 18 months, but they were able to maintain their value, if not even continue to grow at the same time that markets like Evansville, Indiana, saw huge spikes in what I can only equate to a pump and dump scheme, where within a period of 8 months, home prices dropped almost $100,000.
Wow.
It's insane. And seeing as transactions dropped very quickly as well. And so when I'm looking to a market that we want to be marketing in, one, I want to look for markets and zip codes that have continued to see growth pre-COVID, indicating to me long-term demand for that area, which my repeat buyers are going to be buying properties from me. I want to be able to sell over and over again and decrease my acquisition costs. So the better area I can put them in as a repeat buyer, the more likely they are to continue to transact with me. So I want to find areas that have been continuing to increase in property value, if not maintaining it, over the last 6 to 12 months, at the same time that days on market have not gone more up really past what their median was around 2021 and 2022 specifically. So where demand has continued to stay high. And for that reason, a lot of wholesalers I've worked with who are dabbling in the wholesale and flip space have consistently moved their marketing away from targeting flip projects because of their reliance on the fact that interest rates have decreased their end buyers' purchasing power, meaning they end up being stuck paying that hard money costs and their holding costs for months longer than they ever budgeted because they just can't move that product. And so very specifically targeting those zip codes where we can see that home prices continue to be resilient while days on market has stayed strong allows the wholesaler to continue to get into a situation in those markets
Mm-hmm.
where the one, they have multiple exit strategies, and two, the demand is there to continue to inspire their end buyer to continue to transact in that area, and they're not going to be in a situation where the margin has fallen so low over the past 2 years that doesn't make sense. So I took those two things first, and the number of new listings data point that I look at is really there to get an idea on how much competition am I fighting off the MLS. So if I can see where my median home price is continuing to stay stable, where my days on market has stayed resilient while number of new listings has dropped or stayed stable,
Like we
I know
see the
there's a
previous
huge
question.
opportunity. Exactly. It's just a perfect 1, 2, 3. I have this really nice situation where I can come in and provide a huge opportunity to folks who are trying to transact here that they can't find without me, and then shoot fish in a barrel.
Yeah, that's super interesting. And I'm curious to ask, let's just say you had a really short, let's just say you were focused on like what's going to help you next month But you don't care about like
Hmm.
repeat buyers over years or what happens to the values of the
Sure.
properties over years. Would that change anything?
I would say no. I would say no because I'm still looking for an area where my median home price is going to be about 250 to 375, maybe $400,000 on an average transaction, where days on market is ideally less than 35 days on market, and it's been consistent over the last 12 months. And so if I'm targeting an area now that makes money and transacts, it's going to be an area that continues to in the future. So even if I'm not looking at that future long-term repeat business and building a company for the long term there, the fact that I'm targeting areas where the margins still exist and we can get into an area where the product is or I'm necessary to move that product,
Hmm.
the fundamentals are the same. Whether you recognize them or not, and whether you recognize their impact on your success, the fundamentals are the same.
Okay. And in your opinion, exit strategy, if I have,
Mhm.
let's just say I'm wholesale or innovation or fix and flip, or buy and hold, right? I imagine it's at least true of buy and hold. Oh, but
Absolutely.
specifically with the other ones, let's just say, let me just give you like two kind of polar but somewhat similar options first. Let's just say, and on one hand, I'm flipping. On the other hand, I'm
Yep.
wholesaling. Would would you answer that question differently for me in one of those situations, or would it still be the same answer?
My answer to that would be, who are you wholesaling the property to? A flipper.
Probably flippers
A flipper. So
more often than not. Yes,
it's the same question. And like I thank you for asking that.
yeah,
Because when people
fantastic.
ask that, it's like, who are you selling this to? It's
Yeah,
someone who's gonna either fix it up and burr out of it, or there's someone who's gonna be flipping it. So if you're not thinking of what your end client is doing, you're doomed from the start. If I know going into this zip code, right, that home price, the days on market, and the new listings are work, and I have comps showcasing that home prices have continued to stay stable the last 6 months. The median household income is up 15% over the last 12 months at a price range where the purchasing power at today's interest rates can afford the ARV that I need to hit. And I think about who my end client is. That is how you get into a situation as a wholesaler where you're successful because you're giving them the product that they need that they can afford.
yeah.
It's why huge corporations spend billions of dollars on market research on what their clientele can actually want to purchase and what their purchasing power is. If I don't know what Sally wants to buy for me at the local corner store, how can I ever make a profit? So it's really the same question, wholesaler or flipper. It's just what part in the process that you're injecting yourself into.
Yeah, I hear you on that. Let me give you one like example of a caveat.
Okay.
Like I can tell you this happened when interest rates started to go up in some markets. Let's use Arizona as an example. Phoenix, Arizona, massive appreciation for a
Mm.
long time, right? And
Yep.
what's happening for that time? Well, you're buying properties at like 80% of ARV and you're selling them to flippers at like 95% of ARV, sometimes 100% of ARV, because those flippers are idiots at this point, right?
Yep.
And they're just buying too high. But to be fair, there's so little inventory, because we have such a
Yeah.
supply shortage, et cetera, right? So if you're a career flipper and you kind of got to buy properties, you have to stop doing that. Right. So that's what's happening in Arizona. Um, Interest rates go up. What happens after
Yep.
interest rates go up? Well, now the retail prices of those properties, they slide a little bit. They don't slide a lot. Right. So if we're
Mhm.
looking at like what are things selling for in the MLS, it's down a little bit. But cash buyers, those flippers, instead of buying at 95% of ARV, now I have clients that can't sell them for 65% of ARV if they want to,
Mhm.
because they got really skittish because they feel like the
Mhm.
market's going down, right? So in that circumstance, like wholesalers in that market had a really, really hard time for a period of time until we like made it through that cycle. On the other hand, people who were flipping and still going direct to seller, they ended up doing okay in that kind of market, right? So that would be one example. Would be flippers don't necessarily buy always based on the economics of the deal. There could
Mhm.
be some level of perception that's involved in that could cause them to buy higher or lower based on perception of what's going on in the market in such a way that might not exactly match the retail market, because they're trying to look 6 months in the future and often they're going to be wrong about what's going to
Mhm.
happen. So just like utilizing that as an example, but the only way I can think to really know that is you have to know like at what percentage of ARV properties are selling for cash in a market like a
Mhm.
more recent standpoint. But anyways, I'm just like they're just giving you like a jumbled mess of like random thoughts. Do you have any
No, that's
thoughts on
good.
any of that?
Yeah.
Yeah.
No, that's really interesting. It brings up a good point. The discrepancy between data-backed decisions and folks who are transacting real estate based off, their local knowledge, their gut feelings, right? And the potential opportunities that exist for wholesalers to sell to investors that have potentially a rosier outlook than they do based off the data they're seeing.
Mhm.
I think wholesalers that are operating on a what's happening 6 months, 12 months out and checking what's going on in the local market that they're already spending, ads on or doing PPC on, will be the ones that can better buffer themselves against turning tides, like when the interest rate environment is changing. Um, and then for flippers, I mean, you talked a little bit about how flippers who were able to go direct to seller and almost cut out the middleman there would be able to be more successful. Personally, as a wholesaler, I'm a little cautious whenever someone is able to or interested in cutting my out from my entire portion of the business
Yeah.
and which areas they have the capacity to do so. Um, but it's really interesting, where one man's trash, another man's treasure. And that's really, I think, what you're describing there for folks who are willing to ignore the data to transact where they feel like they can. But I think what we also pointed out was when you do that, you're also the person that's at the most risk for when those retail prices start to tumble. And cash buyers, even more so than the data backs up, are more fearful than, say, they necessarily should be from a analytics approach.
And it always makes sense after the fact, right?
Right.
Oh, they shouldn't have been so scared. But then there's another world where everybody lost a lot of money. I think, well, you should have kind of
Exactly.
seen the writing on the wall of what was happening here, right?
Yeah,
So, but it is
exactly.
interesting how there's like, with all markets, there's some emotion that plays into things,
100%.
right? And it does seem like for years we were kind of operating on the bigger fool strategy, where like, yeah, I'll get this property under contract with the seller, and is it actually worth paying this much for the property in a cash transaction? No. But I know that there's another person out there who's an even bigger fool than I am,
Yeah,
and I'm going to make the money because that person's going to buy from me.
right.
Cool.
And then you can point to things like market trends, like, well, look how much we've gotten up the last couple of years. Let's see where we can go. And that's you see your listing descriptions or your, wholesaler dispo descriptions talking about all the great things that are happening. Absolutely. And that's kind of where you have, a boulder that's kind of rolling downhill on. There's always someone that's going to be crushed afterwards. That's going to get it worse than I am. But eventually, I think that stops. Where we see, huge market shifting events occur, whether that be something like COVID, where interest rates drop really quickly, versus interest rates come back up really quickly, or legislation. At some point, things hit where fundamentals are required. This guy, if I take a quick turn to like the VC industry for SaaS companies, right? When you're looking at valuations for software companies, people are raising capital, and there's a period of time where it's like, you know what? $1 billion valuation. I don't care that your churn's at 30%, and I don't care that you've never made a profit and your LTV is non-existent. That's fine. We're just going to keep pumping cash into this thing until
Yeah.
all of a sudden things aren't as rosy anymore. And then that's when fundamentals matter. That's when valuations come down. That's when people start reconsidering what they're willing to do because the safety net of
Yeah.
there's another fool out there starts to diminish. So in this point in time where we're seeing the market continue to really fluctuate, I think fundamentals matter more than ever. But on the other side of that, had a lot of talk from the Fed recently on what's going to happen, say September, October, November, December 2024. And if we're coming on the other side of what 2023 and 2024 have been.
Yeah.
And so I think we're going to see a potential return to the fact that, look, we made it through. And I think you're going to see an almost like zealous population of real estate investors that are going to say back to business as usual. Things are easier again. And I can just see that folks who are too anxious to be able to use the strategy of a bigger fool is coming behind me too quickly into a potential turning of the market might find themselves just at the final point where they're about to cross the finish line, stumbling because they were too ready to go back to a point where they could overpay for a little bit on these assets.
Yeah. Yeah. That makes sense. You like the Warren Buffett of market selection.
I mean, I'd love to have that comparison be made. I'm going to
Mine's
quote you on
60
that.
years.
Yeah, mine is a few years. Hey,
Well,
I turned 25 2 weeks ago, so I got 70 years on him, something like that.
yeah, yeah. I would say, you don't quite have the track record yet, but in terms of thinking and philosophy, yeah,
Oh,
that's right.
exactly.
That's cool. Okay, so to summarize what you said, it sounds like like the fundamentals in your opinion? You're saying maybe this changes a little bit based on like, the bigger fool strategy, what's happening in the market, like emotions, et cetera. But like the real fundamentals here behind everything are what's the median home value? And I imagine you'd probably say, well, you don't want to be looking for really low median home value because there's not a lot of money to be made on those deals. You
No,
have to, there's got to be some
no.
meat on the bone. And then you're also looking for appreciation of that median home value. So, we're not looking at a market that's been hit really hard recently. Ideally, if there's theoretically, if there's a solid appreciation over time, then there's also equity.
Hmm.
And if there's not solid
Exactly.
appreciation over time, there's less likely to be equity. Of course, there always can be
Yep.
equity. Um, and then days on market and
Yep.
new listings on the market, which I imagine is kind of it's like days on market's sort of what's happening, and then new listings on the market is sort of like the forward looking look at what's probably going to happen to days on market. Like if that's increasing at time, then it's likely that days on market will increase soon.
Yeah, generally it's an inverse relationship where as the new listings drop on market, depending on other certain fundamentals, like if my days on market are continuing to increase, right, then I would usually expect that there are more properties on the market,
Yeah.
right? So new listings are increasing. But if I'm seeing a very specific situation where my DOM is increasing month over month, but my new listings are going down month over month at the same time, that gives me a huge red flag on demand in my ability to be able to transact or sell to someone based on the fact that we're not seeing a lot of business moving on. On the flip side,
Yeah.
if I'm seeing my new listings continue to, go up and my days on market are continuing to go down, a huge green flag on demand for this area on what's continuing to happen and my ability to look forward as a marketer. And so, exactly.
Yeah. But that would all be retail demand.
Generally so. Yeah,
And
that's generally
are
retail.
you aware of any way to measure similar things from a cash buyer standpoint? Or are we kind of like left looking at the retail demand as kind of the fundamental probably behind the cash buyer demand
Hmm.
and sort of looking at it that way?
Yeah, so when looking at a cash buyer perspective, a lot of the value that a cash buyer is bringing in via a wholesaler is the fact that they're bringing off-market opportunity that, generally speaking, is going to be more affordable or it's going to be at a better margin than what I could get on MLS.
Yeah.
Right? Like that's a huge value component for the end buyer of a wholesaler. And so if I'm tracking the retail market, in the retail market, I'm watching home prices continue to decrease while my days on market are going down and new listings are going up. I'm in a situation where it's getting more and more difficult for me to yield a better margin or a different transaction than someone could get on the retail market. And so I think wholesalers are in this almost never ending battle, kind of quid pro quo against the MLS and what people can get on the retail side based on the fact that their huge value component is that they're bringing deals that offer a better margin or easier access or this kind of secret treasure trove of opportunity that people can't find anywhere else. And so I think the smart wholesalers are the ones who are keeping an eye on the fact that they're not just competing against other wholesalers. They're competing against this larger, millions of consumers and mom and pop flippers that are looking for an opportunity, or even more institutional who are looking at MLS and retail investor side to pick up opportunity. And so I don't necessarily have an idea on, or don't have a way that I could be tracking how many days, or really in some cases hours it takes from an off-market property to be sent out to your dispo list and then be picked up. Uh, but it's something that I think wholesalers have to be cognizant of if they're going to continue to be operate in this market where you have millions of both consumers and hundreds of thousands of investors on the sidelines who are watching retail prices as an indicator of their buying activity.
Yeah. That makes sense. Cool. Is there anything else you look at?
Yeah, on a more specific level, like when I'm looking on a deal by deal basis. So, for example, if I'm getting leads through, my acquisition channel, PPC comes in, hits my CRM, and my VA is looking at them, I almost always keep in mind my end client. So, am I selling? If I am going to plan to wholesale this or do like innovation, and I'm going to sell to an owner occupant, they are very much going to be concerned on local school rankings and local crime. And so if my end strategy I want to include something involves going direct to consumer for this asset in some way, I don't necessarily have to build in a margin for those folks, so I'm able to go to maybe a little bit higher median home price, but things like being on a double yellow road, having school rankings that are above a 4 out of 10 on a grade school's ranking system, and being avoiding of areas that have higher levels of aggravated assault, simple assault, vehicle break-ins, or weapon law violations are all things that your end consumer is going to be watching, or their agent is going to be advising them on when they go to transact. On the investor side, if I am trying to sell property, I'm also generally going to look at things such as local income, local franchises. A lot of investors will buy off of, well, if Chick-fil-A and Starbucks and Target are here, then I want to be here. So looking at assets that have proximity to those types of huge, almost indicative of what's coming to an area establishments is a great way that I'll use to double check what other companies are doing in the area. So then when I'm going to dispo that property, I'm saying, look, half a mile from your Starbucks, quarter mile from your Chick-fil-A, income's going up, rent growth year over year is up 10%, 5%, whatever that number is. Those are the things that I know my investor client on the back end are going to be looking at. So I'll check all those things as well. So my ideal situation after getting to a market that has the right, let's say, days on market, home price, and new listings, if I have an asset that is also around high school rankings, low crime, with proximity to those higher income targeting establishments with year over year positive rent growth, all that upfront work makes that property a steal to sell on the back end. So you're decreasing your time to sale, and you're able to start transacting properties a whole lot easier, and you don't get stuck with, I can't move this asset. And that's what a wholesaler's worst nightmare is, right? I've got 10 properties under contract, and my EMD or my window to withdraw is in 7 days, and no one's biting. So we want to avoid having to hold those properties on books by looking at some of those more specific intra-market things on a deal-by-deal basis.
Okay, that makes sense. So you wouldn't look at it and say, I'm not going to target this area because of this. You'd more look at it as, well, now that we have a deal available in this area, this is the information I'm going to use, almost as like as part of the comping process, like understanding how much you're going to be able to sell this for.
Absolutely. I mean, once you have some of your high-level market indicators saying, look, I'm marketing to this area, the next step is on a deal-by-deal basis saying, what is my risk tolerance for this specific asset? Like, I know this area, let's say the zip code is definitely something that I'm interested in, but this street over here, I'm going to have more time. Like you said earlier, right? Which county, on this side of the county, I'm doing great. This side, I'm not doing so hot. Can we get that specific on a deal by deal basis? So as part of the comping process, I know before I ever write that offer, or I'm going on an acquisition manager is doing a meeting with the seller, I know exactly what my likelihood is of being able to sell this thing based on the street by street analytics. So that way you go down from, hey, 2 out of 10 properties or 3 out of 10 properties that we're picking up, we're having a really hard time moving. You can remove those overnight by just having a little more time spent on the analysis when you're pre-comping these deals. 100%.
That makes sense. Anything else you'd look at?
I generally, well, ideally, this is someone who knows their buyer list. So this is more applicable to someone who spent time curating their list and someone who has spent time interviewing some of their buyers. But I think it's critical to understand what their exit strategies are going to be, right? Is this a person that says, I'm going to turn this into an MTR or STR? I'm going pad split on this deal, and it's going to be a room by room strategy, right? I really want to understand, what is this person trying to do with this asset? Not that I have to speak to every single person on my list, but having segmented out their top 3 strategies that they're trying to acquire properties for is going to be huge. Whether I'm saying, look, I know this person, like in Seattle, right, is only targeting properties where they have a lot size of over 5,000 feet, so they can add an ADU on the back. Okay, great. So when I'm doing my comping strategy, my PPC strategy, and I'm targeting these areas, and then I get my VA who's doing the comping, if it doesn't have this type of, say, lot size, and I know a significant portion of my buyers list in this area are looking for that strategy, why waste another second on that deal? Because you already know that a large majority of your buyers list is not going to want to take that deal down. And so things like that, which is, are they going to do a pad split? Great. Then I need to have the square footage or the capacity to be able to add some other bedrooms. If I need to be able to do a short-term rental, okay, great. What are my local regs looking like? Or if I'm doing something like a mid-term rental, are there major attractants, such as things like, in Georgia, film industry, or around major major hospital systems, that my end buyer is going to be successful? So If I had to summarize everything, try your best to set up your end buyer for success, so then you'll be successful. If I can make one piece of advice, knowing who you're selling to by using data in a fast way will help you move product faster, easier, and a better margin because you're matching what you have to sell with what your client is demanding.
Got it. That makes sense. That's cool, Donato. I'm gonna have to listen to this one again and see what we can do to revamp some of the strategies that we're using to target markets for our clients, because it's super interesting, some of the information that you shared. Any last words of wisdom before we close this episode out?
I would say thanks for having me on, and I would say there are so many opportunities across the nation that real estate is a national game. That's why you've seen some of the top wholesalers and folks in our industry move away from markets they've historically been successful in and target secondary and tertiary markets in major cities and continuing to go to primary markets in smaller, less known areas. If you want to be successful, you got to go where the fruit is growing. And that means you got to play real estate on a national level. And so if you're not already doing that, you need to. And if you are doing it, work with people, use the data, and target things effectively so you can minimizing your CAC, you're minimizing your speed to lead, and you're able to move properties faster and easier than anybody else because your head's not in the freaking sand. You can do it, so do it if you want to be successful. That's what I have to say.
Yeah. Yeah, that's awesome. Thank you for your time and all the wisdom you shared with us today. And for anybody else listening, I will see you next week.